Hello and welcome to this week's episode for Spy Trader Now. I am your host. My name is Ken. Today is September 30th, 2023. Our model portfolio is up year to date 6.27%. The S&P, we compare ourselves against the buy and hold investor for the S&P 500. The buy and hold investor is currently up 11.64% year to date. Our goal here at Spy Trader Now is to beat the returns of the S&P 500 buy and hold investor. I know we're not accomplishing that goal right now, but if you'll stay tuned, you'll see how my portfolio is positioned. My expectations for a bounce in the next week or two, I'm going to profit off of that bounce and then change my trades, put some trades in, take some trades off the table in 1 to 2 weeks to take advantage of the downside move I am expected till the end of October. So that's my expectations. Stay tuned to see how I do that. We do a simple portfolio, 3-position portfolio here at Spy Trader Now. We start the year off with $100,000. And by the way, this is investment grade capital, not trading capital. I know I have trader in my name because we trade the account, but I do it in such a conservative way that this is with investment grade capital as opposed to just trading capital. Here are some past returns in 2022. Good year compared to the negative 19% the S&P 500 buy and hold investor experienced. And then you can see the other returns. 2020, we doubled the portfolio. Last week, the S&P 500 lost 0.68%. And we'll go through the charts in much greater detail, but you can see right here how we are in this trading range right here. And we are hitting a support line here and another support line, if this one fails, just below it. So we've got plenty of support to help us bounce and come back up to this resistance line. Here are the trades that we made last week. I put on 3 long call options, and the exact option was January 19th, 2024, expiration 440 strike. Those options cost $12.09 each, or 12.08. I actually think I put 1 penny more there. Anyways, that's 2 to 3% of the portfolio we put into long calls. We still, by the way, have plenty of cash. If you noticed on the first slide how much cash I have plenty of cash just sitting there that if I want to deploy that, I could. Now, here we are looking at some of our trades and our most recent trades. There's that last trade that I put on 9/26/23 that I told you about. And if you want to see all my trades going back for 3 years, you can head over to spytradernow.com. There'll be links down below in the description for everything that I'm talking about in this presentation. If you have not done so already, go ahead and hit that subscribe button, ring that bell, and smash that like button down for me. Thank you. Here is our equity curve for our model portfolio for 2023 year to date. Here is the equity curve for the S&P 500 buy and hold investor for year to date 2023. And here are the 2 equity curves combined. Now our goal here is for our model portfolio, which is the blue line, to beat the pink line, which is the buy and hold investor. I know that we're not currently doing that. And last week I took a pretty good hit because I went long with some leverage. But if this market does bounce like I have an expectation for it to do, we will beat the bounce on the S&P 500 because we have some options going long in our favor. Here are some interest rates done by the Fed. This is the Fed Chair Jerome Powell. Going back the last 2 years, you can see all the rate hikes. The last announcement on September 20th was a skip. It was not a rate hike. The next announcement for the Fed is going to be on November 1st. Will we have a 25 basis point rate hike, or will we skip again? Unknown at this point in time. It's a little unclear. So we'll just wait till we get closer to that date. We have a whole month before we get to that date. Now we're looking at things from the presidential election cycle theory, which states that depending upon the year of the election, will give you historical rates of return for the S&P 500, and I also put in historical rates of return for the NASDAQ 100, symbol QQQ. President Biden is currently in his third year of his cycle. That historically averages a 16.3% return. Currently, the S&P buy and hold investor is up 12.64% year to date, giving plenty of room, another 5% advance between now and the end of the year with this theory. Now we are looking at things from the bond market outlook. The bond market is basically saying stay out of the stock market because you still have an inverted yield curve, although the rates are getting closer together compared to just a week ago, and you also have rising interest rates. Both of these things from a bond outlook are negative for equity investors. Now we are looking at things from a valuation according to CMV, link here and in the description. We're overvalued, and we're overvalued by 53.6% above the modern era market average of 20.2, putting the current PE, which is price per earnings ratio, at 1.4 standard deviations above the average. So here's the PE on the chart, and you can see 1.4 standard deviations. So just to summarize this, there is risk in this market at this time. You can have risk though for long periods of time, so it's difficult to trade just based off of this information. Now we're looking at CNN Business Fear and Greed Index. This is our friend Warren Buffett, the sage of Wall Street. And currently we are at the very low end of fear and almost in the extreme fear category. And we are dropping. 1 week ago we were at 34. This week we are at 28, which is good for going long because when you want to be greedy when others are fearful. Now we're looking at things from a seasonality outlook. So depending upon the month, this is going back 20 years on a seasonality chart. And here are the different months. We are just wrapping up the month of September. 65% probability that we were going to close higher than when we opened. These are called the summer doldrums. And then October is included in that. Come November, there's a 79% chance that we're going to close higher, and then December, 68%. So the bounce is expected to come between the end of October and the beginning of November. This is that bounce seasonality that gives you the higher odds of the stock market going up after October. Now, currently for the month of September, we are down for the month 4.74%, and the trading is completed for the month. So on next week's presentation, when I give you this for the month of October, the month of October will be just about a week old, and this month will be closed out. You can see the really long or big red bar. Last time we had a big red bar like that, it was followed by a white bar indicating positive for the month. So on this month here in 2023, it opened here and closed here. Now, if we open here and close here, then that's going to be beneficial for my strategy that I'm trying to implement, but we shall see. Nothing is guaranteed. Everything is just probabilities. Now we're looking at a monthly chart going back 20 years for the S&P 500. Nice bull run, 2009 all the way to 2022. Downward correction, broke out above it, and we're in a long-term bull market as long as we stay above this line here and this line here. Currently, we are above both of those lines. My expectation is that we're going to stay above those two lines. That's not a guarantee, it's just an expectation. Now the MACD, it has topped and it is beginning to travel towards its signal line. That's the MACD. This is slow stochastics. Slow stochastics has already crossed below its signal line, but it is still above 80. Still bullish, still generally bullish even though the market has softened up recently. Now, this is an intermediate term outlook going back 5 years for the S&P 500 weekly candlestick chart. We are in that trading range right here to here. And if we hit this, we may actually catch this support and bounce from here, or we may break through it, go a little bit lower, and then bounce. So we shall see how this plays out next week. Now, this is a short-term outlook. And here I can show you some of the trades that I placed. Now, the last trade that I did was on 9/26/23, where I bought 3 calls on this candlestick here. Now, I ended up buying those calls early in the day when the market was up here. Then the market came the next day, bottomed. The next day had a little bit of sideways movement, and then here it went up, but then failed and came back down. So I'm a little bit negative in these 3 calls right now by $2. So let's see if this can catch this support and then continue to go up to this level here around 440 or so. I don't expect the market to go certainly past 450. And if it goes to 440, I'll be taking some money off the table, and I'll show you that later on in the presentation. Now we're looking at a ratio chart with the RSP equally weighted S&P 500 against the SPY normally weighted S&P 500. Now, so you have the ratio chart, which is in red and black. The green line is the equally weighted. The blue line is the normally weighted S&P 500. Okay, here is your bull market from 2009 all the way to 2022. Under a normal bull market, the equally weighted surpasses the normally weighted. And when you have a correction, you do the S&P 500, which is the blue line. You see that you drop off a cliff here, and you dropped off a cliff here. In the MACD only came down to this level in the last 20 years, only 3 times. And right now is when we came to that level as well. This level at this very low juncture, once you cross above the MACD, which we've already done, generally that is the bottom of the market. So I've marked that with this blue dotted line here, here, and here. So here where the blue dotted line is, you can see that the stock market was very close to a bottom, but it did still drop after that before actually starting, but before reaching the bottom and then going. But we are within months of that happening. And then here, the market was already past the bottom, and it just continued on. Here we are here, but the S&P 500 is still at an elevated rate. It would sure be healthy for us to have some significant pullback where you can see it noticeably on the chart, as opposed to these little gyrations. These are nothing. So we're watching this very closely to see how this ratio chart plays out. Now we're looking at the VIX volatility index, or the fear index. We were in this ultra low trading range for the VIX. Then we jumped up into this, which is still low because it's below 20, this low trading range. Once you start getting above 20, that's when you're starting to see the stock market come down. You'll see the stock market is in this black line. The S&P 500 is in this black line here. And you'll notice that when the MACD went from here and up during that time frame, the stock market went from here and then down. So it's an inverse relationship. Here we are right now, and there is room for this to drop, meaning that the S&P 500 will go up, because it's an inverse relationship. But even if it stays in this range and doesn't go over this top, the market can still continue to rise. So we are watching the MACD as well. We are watching the VIX as well to see how this plays out. Now we are looking at the Think or Swim trading platform, and here we've got the standard deviations, +2, +1, the regression midpoint, -1, -2. Now on today's presentation, I'm giving you the one standard deviation above and below the mean encompasses a 68% probability that you're going to stay within that area. That means that 95% of the time, the sample mean will fall within the, now I rounded that out to two plus 2 and minus 2 standard deviations, but it's technically 1.96. But just round that out to 2. So that means 95% of the time you're going to trade between here and here. 68% of the time you're going to trade between here and here. We are now at the -1. We've bounced off of it, and there's a 68% probability that we are going to come up and not go below it. There's still a 30% chance you're going to come down so a little bit further on this 1-year chart, but let me show you the next 2 charts. Now, this is the same chart, but only going 6 months of data. By the way, we are bullish, generally speaking, because if you look at the standard deviation lines, the angle of ascent is sloping upward from the left-hand side of the chart to the right-hand side. Now, when I show you the next 3-month chart, you'll see that's not the case. But over the 1 year and the 6-month term, that is the case. Now, here on the 6-month chart, we actually did come down, just about kissed the -2 standard deviation before bouncing. Now, I want you to keep in mind a couple of things. The more time the chart shows, the more data the chart shows, the more accurate the standard deviations are going to be. The shorter the time frame, there's a higher probability that you're going to bounce out of the standard deviations. So as you keep getting smaller on your time frame, there's that probability increases that you're going to come out of it. But it's all just probabilities. Now we are looking at the 3-month chart. I want you to notice how the slope has changed. Over the last 3 months, now on the standard deviations, you are going from the top left-hand corner of the chart down towards the bottom right-hand corner of the chart, meaning that you've lost momentum over the last 3 months in this market. So we can certainly have more significant falling to go before this thing turns around. But on this 3-month chart, we did kiss the -2 standard deviation, bounced off of it, and now we're heading north at this point in time. I have just given you a ton of information in this video. Now comes our critical thinking. What are we going to do with that information? This is how I am going to play this market. This is my critical thinking. I would love to know what you think of it and what you're doing and so forth. So let's go through it. September 30th, 2023, market summation according to me, your host, Ken, with SPY Trader Now. I already told you in the presentation that I went long on 9/26 when I bought 3 long call options. If you look at the chart pattern, you'll see that I was 1 day early before the bottom so far, unless it bottoms out, and I was just wrong in my prediction. On the 6-month chart, there is a 95% probability that we will not go below 421.53. I do have an expectation for the market to bounce here for 1 to 2 weeks and then head down again, taking out the 927.23 low of 422.29 on SPY. So this is how I plan to trade this market. I'm going to stay in my long call, and I'm going to hold my ETF stock holdings of SPY, and I'm going to let this market bounce. If that happens like I want it to in the next 2 weeks, I will sell my long calls when SPY reaches approximately 440, about 3% higher than where it is right now. I will also sell 2 in-the-money covered calls with 410 strikes or 400 strikes. Either one of these 2 is fine, with an expiration date of 10/27/23. And if we do get that weakness and further drop, taking out the old lows, I will buy to close the in-the-money options, profiting that difference, because when I sell the in-the-money call when the market is at 440 and I buy it back to close it when the market is at 410 to 400, there's I'm going to be pocketing a massive amount of money there because I'm going to be buying that back for much less money than when I sold it because the market dropped and it was an in-the-money covered call. I may also buy some puts if the market does reach a level higher than 440 and it looks like it's peaking and topping out. Overall, I'm expecting weakness till the end of October and then strength till the end of December. Now that may or may not pan out. The seasonality states, I should say, that normally November and December are going to be strong months, but it is possible that November and December this particular year could not pan out. We have to see how this market plays out. So it can only go so far out in time duration to make really good predictions. So we'll see how this all plays out. I hope you got some valuable information out of this video. If you have not done so already, go ahead, hit that subscribe button, ring that bell, and do me a solid and smash that like button down for me right now. I thank you and I wish you good trading.